platform on this session on financial inclusion, reaching to the last mile. Most of you, I don't see many people. I hope at least there are a few bankers around here. What has NABARD got to do with financial inclusion? I think plenty, because we hold two of the most important purse strings, two important funds, the Financial Inclusion Fund and the Financial Inclusion Technology Fund, which is managed by NABARD. So all those of you who are interested in IT-related last mile connectivity, you know where to go. There's not much to say as far as NABARD's initiative. I would rather be a little more focused on the Kerala initiatives. And for most of the old generation bankers, I'm sure financial inclusion is there is something new. Although for the last few years we have been, these two words, financial inclusion, has been the buzzword. Ever since the nationalization of commercial banks had taken place, the policymakers had acknowledged that it is necessary and it is important financial inclusion to take place. Credit targeting approaches like priority sector norms, no-frill accounts, basic savings and basic deposits accounts, regulated microfinance, all the interventions had one underlying idea: to make the unbanked financially inclusive. The decades of attempt to reach the unbanked through these alternative approaches met the desired objectives only partially. Mid-course corrections, both in policy and in approaches, bear proof of this, but the intent has always been to reach the unreached. The Reserve Bank of India, the main player in the financial inclusion policy, had since the last decade placed greater emphasis on the outreach and expansion of branch network. The bank-led model approach to expand the outreach and financial literacy to empower the masses have been the guiding principles of this effort. To pursue financial inclusion as a commercial activity and not to view it as charity or service has been the hallmark of this approach, which makes it self-sustainable and commercially viable. This, I believe, would enable financial inclusive initiatives to scale up and cover more areas. The National Bank for Agriculture and Rural Development, or NABARD as it is more popularly known, had pioneered the strategy of self-help groups and the bank linkage program in pursuit of its mission for achieving equitable and sustainable growth. It had designed, developed and facilitated the SHG bank linkage program in India since 1992 with various partner agencies like banks, non-governmental organizations, government agencies, departments. These SHG bank linkage program and other microfinance initiatives of NABARD had contributed immensely to the financial inclusion process in India. Let us now focus on Kerala, where these efforts have borne fruits. The group-based approach has been accepted as a reliable model, which can be confirmed by the ubiquitous presence of neighborhood groups and the dominance of Kudumbashree, a state government initiative in implementing various government-sponsored programs. Today, with around 5,800 commercial bank branches, 2,500 touch points of cooperative institutions, we can safely assume that this state is well balanced, well endowed as far as outreach is concerned. Banks have adopted innovative delivery models and alternative channels to achieve this benchmark. Thus, just as the convener of SLBC has stated, SLB had declared Kerala as 100% inclusive, 100% households who are having at least one bank account. I think the banks need to be congratulated here. While banking accounts could be the first and the foremost step of financial inclusion, it is certainly not the end-all of the process. It brings us closer to our ultimate goal, empowering the underprivileged to lead a more self-determined life and improve their livelihood. Again, from the supply side, it can offer various social benefits by appropriately targeting and transferring the benefits directly into their accounts. On the demand side, creation of awareness by means of financial literacy is the key to success. This would create a demand for various financial products like credit, savings, remittances, insurance, and finally contributory pensions. For financial accounts to improve to improve to a level where benefits are generated beyond the account, a focus on the last mile becomes critical. Addressing real user needs by aligning product design, distribution, business models, and financial inclusion. Only a massive social mobilization involving painstaking and long-drawn campaigns that resist the temptation for target-driven, quick wins and band-aid solutions can bridge this last mile. In the context of Kerala, let me, one hastens to ponder, with such an outreach, what drove the people to approach, what drove the people in Kerala to approach the informal sector for their credit needs? What I'm talking about is the money lender. Was there a trust deficit? Was it due to ease of business with the informal sector? Or because of the inability of the poor households to afford to meet even the basic requirements of KYC for getting bank loans, such as obtaining a photograph or income certificate, or even to sacrifice a day's wage for completing the loan formalities? This, we believe, is a major hurdle in accessing credit from banks. The moneylender, therefore, appears to be a messiah to the poor, as he is more approachable and, unlike banks, provides the services at the doorstep. It also goes on to prove that there is a market or a demand at the bottom of the pyramid. Having said that, let me hasten to add, I'm not talking about the fortune at the bottom of the pyramid, which I believe sounds a little inappropriate in the context, but a reasonable amount of profit to make it sustainable. As a development banker, the situation prompts me to ask, what are the flaws in the design? Why do a customer or the bank fail to meet eye to eye? How do we attempt inclusion by providing access to reduce poverty and inequality? Well, information communication technology does provide tools to reach unreached through ATMs, mobile banks, kiosk banking, and the whole gamut of techno services. With a decade of experience in various technological innovations, we really need to take a closer look into the efficacy of these measures, especially to reach the unreached. While technology can provide connectivity, we need to examine how many are actually getting hooked onto it. It is in this context cooperative banks become relevant. The local nature of these banks and the consequent information advantages, the knowledge about the forthcoming business opportunity, as well as borrower quality information that national level banks have a hard time gathering, place the cooperatives at a very advantageous position. This also manifests in the flexible and customized service delivery these banks that can be more responsive to the needs of the local community. What then are the issues with governance? But there are issues in the governance of these rural financial institutions. The cooperatives in Kerala are quite different from their counterparts in India. They are robust and healthy. They have a network of around 2,400 branches that includes 1,600 primary agriculture societies. These primary agriculture cooperative societies, or PACs as they're known, have a membership base of about 1.35 crores, and as on March 2012, they boast a deposit of around rupees 40,000 crores and a credit outstanding of 46,000 crores. Most of these PACs have adopted technology, and almost all are computerized. This is unique to Kerala. Well, there are other issues, but I think for the paucity of time, let me just mention, yesterday we had a national conclave of microfinance in NABARD, where Dr. Raghuram Rajan, the governor of Reserve Bank, was invited as a special guest, and he had made a few important points. In his keynote address at the National Microfinance Conclave at NABARD, the governor stated that the 4 A's, accounts, Aadhaar, access to finance and activity in the account, and the 5 P's, products, place, price of the product, protection of consumers, and profit to the lenders, can create a vibrant financial market for the poor. Let me, in conclusion, stress on a very fundamental point. All these initiatives ought to be strongly backed by political will. The RBI governor rightly voices his concern on misplaced subsidies, creating price distortions in the economy, and the adverse impact on banks by the populist policy of loan waivers adopted by various governments at different points of time. His advice to the policy makers was to transfer such benefits or subsidies directly to the beneficiaries' accounts without distorting the market or the good credit ecosystem painstakingly created by the banks. I believe that political will, political support, policy support, and the spirited backing of the stakeholders would definitely make our dream of achieving inclusive growth come true. With due apologies to Robert Frost and in the context of the title of this session, let me finally conclude by distorting his poem. The task is complex, arduous and steep, but we have promises to keep and miles to go before we reach. Thank you, ladies and gentlemen.